So that looks all right. Okay. So here's what we got going on. We had the market pressing up. We were leaning into the velocity sample. The lean cooled off. We started to see the bears back off their idea to try and pop into the market. And you see tension got, we are at a zero test right now. Well, why do I care about these? What is a zero test? If you think about the possibility space in the market as a spectrum, so let's say this spectrum, and you have different things that could happen along this spectrum. Well, if tension is the line is above zero like that, and you have negative tension, then what's going to happen is that these things are more likely. The things that are bullish are more likely, and they're easier to happen. So at a zero test, we're seeing the bulls get their control over the market for the past day and a half or so challenged. Now, if they lose this here, they don't defend, then this can move under. And what the bears will do is they'll want to try and get daily tension under zero tomorrow like this. That's what they'll be looking for, is to do something like that. So right now it's getting challenged. What's difficult about these is that there's flexibility around the amount of time they can take and the way that they work out. So this is very normal during a zero test. There's a little bit of flexibility about how far under this can go. So a zero test doesn't have to be nice, clean, and perfect. So you have to keep that in mind in terms of the structure of the market. How this zero test has worked is that we had our weaker position bullish right here and right here. The bulls came in, remember, and they were not impacting tension. So to some degree, you could look at that as failure. I've been looking at it as a statement to the bulls that they intend to try to defend the market, but they are not official positions. These are not large institutional positions. They were just price only. They didn't impact the probabilities of the market. So what has happened is you can see this came down and has pressured those statement positions in the market. It is putting pressure on them. And we're seeing trapped orders coming in, and this is a good thing for this being a zero test. I think this has a good likelihood of closing quite flat right here. And the bears have done everything they can since the open. And at this point, we did not see this position get liquidated. So this was a front run this morning of elasticity, right? So the elasticity, they were thinking, hey, if the bulls move out of the way, then we could see the market move down further today. The elasticity did not happen, and the bulls were looking to push this up and liquidate them around this price here. So that didn't happen. Now, at this point, we have these guys. We're able to front run the potential. I have a 5-year-old who needs to sing right now, so I hope that's okay and it's not too loud. So they're front running the idea that this is going to get pumped down and that daily tension can get under zero tomorrow. That's what they're trying. Now their mentality is move forward. They didn't get pushed out. So this is a tough position for the bears right here. They're front run. I don't know if the thing filters the singing or not. Hopefully it's filtering it. I don't know if you can hear a 5-year-old singing in the background. Anyway, this front run, first it was hopeful here, and then it failed. Then it turned into a squeeze, and now it's back to a front run. So this is an extremely difficult position for the bears. Anyone who held on to that position is insane or cheating. Now, the reason I don't quite think this is cheating yet is because they haven't actually been holding on to risk. I need to see a short position come into the market and then see price move negatively against it for a while and then see them win. And then I would call that cheating. This is just difficult. I see what they were front running earlier today, and I see why they're holding now, and I see that the potential for them is still pretty limited, in my opinion. The bulls still have the potential to pop this up tomorrow and run this, and every single bear who tried to come in here for whatever reason, which I don't think there was any good reason, will get liquidated. But the other thing to look at here that I think is important for the bulls is right here. You see this? This is a decay retest. We have a multi-day decay retest, and that multi-day decay retest, so this pivot, actually no, I shouldn't draw that on there because that's onto prices, is giving us a decay retest, a risk reduction for the bulls. And the question you have to ask is, one, do they have no other options? And as far as I can tell, velocity can't sample bulls, decay can't sample bulls, so check. Two, they want to play, we'll say play. And yes, we saw earlier they were doing things that I was interpreting as making statements, we do want to participate. So I think this looks like this decay retest meets the qualifications. I think that the bulls would like to pick up this decay retest and pop this higher. There's our trapped orders. We're getting new highs. This decay retest is in play right now. We have a zero test that could pop up overnight into tomorrow. So I think this decay retest looks much better than a lot of the other things we've seen today. The top position that I saw today to trade was right here. I've been calling that number one because the conditions I think lined up and were able, you could know them about here, or at least understand them here. Things have been difficult for that position. Now we're getting a zero test, a decay retest. We have established the intent of bulls, at least a statement about it. And we have the bears trying to run the market down and through zero, and they did it without permission. So I don't think that the bulls stepped aside here. They hit price. So the bears did not have permission by the controlling party to attempt to take out tension. So I think this is setting up for bulls to drive this up higher tomorrow using this decay retest. This is how I'm interpreting this. I think that the bears, this position was out of place. Even though it hit and it did work here, they didn't have the structure to pull that off. And so I think that that was a premature position. So this is what I think is going to happen. So we're covering my opinion from the way that I see it. And this is the thing that I think is going on. We got ourselves a decay retest at a zero. I think this is the good spot for the bulls to come in. If they're going to come in, this is it. And this was a statement. This, I think, is an institutional opportunity. So that's what I think this is right here. Let's take a look at the bears and what they could do with this position that I think would be good for the bears to come in, or the bulls to come in and pick up. If the bears, and they need this now, not none of this. I don't. This doesn't matter. If they can get this to drop down and wipe out this decay retest, I think what's going to happen is we're going to see some trouble overnight. The bulls have a good chance here. They've established themselves. They've been able to do a lot of things, I think, that suggest that they're dominating the market. They have taken over. They're in control of the trend. We're getting a point where that we get a stress test, and we always see stress tests. This is a normal thing in the market, so it's nothing to I think the world is going all over the place about. We need stress tests over and over and over and over and over. So you have to be really familiar with how to break down a trend in order to understand how stress tests work. Because if you don't know how to break a trend, you absolutely don't know how to trade one. You can't trade with the trend traders thinking that you can neglect how to break them down, because what gives you strength in the market, what makes you strong, is how breakable you are. That's it. There is no such thing as I have a lot of money. There's no such thing as price moved aggressively, breaking through levels, getting above or below an EMA or an SMA. Those things are parts of strength, sure, but they are not strength. At the end of the day, what is strength is your ability to resist breakdown. And this is where it gets difficult, is that your ability to resist breakdown has to do with how well your opponent can't beat you. Think about that for a second. It's not that you went to the gym and you're strong. It's not that you have a big fortress and your house is impossible to penetrate. That's not what makes you strong. What makes you strong is your opponent's inability to get up and do anything. Your opponent's inability to execute on the plans that they have. Your opponent's inability. That is what gives you real strength in markets. It is not about you. You can't think that strength is exclusive to one or another person. It is a mutual understanding between people. Power is a social construct. It's something we do with each other. Sure, guns could give one person leverage, and leverage is a form of power, but it's not the best form, because shooting your opponent ends the game. And that's not what you want here. Like we don't want to end the game. We want to win the game. Winning is where that you create the inequality that produces opportunities. So you don't want to end your opponents. That's bad. That's wrong. It's bad in the sense that it ends the game. You want to beat your opponent. And so in this, you have to keep in mind, this is a social game. This is not a war. This is a game. So their strength has everything to do with the Bears' inability to win. And right now is a tipping point where the Bears potentially, if they could get something devastating in the world, that's what they would need, is something devastating. And they were able to move this down far enough that we opened this lower, and it was able to get both the daily under. The issue here is that I honestly think that if daily tension gets to 0, there is a very high chance the bulls will show up. If that happens, I absolutely think the bulls are going to try and defend that. So if we open tomorrow lower, this would open under. And I think it would almost immediately shoot right back up. And price is opened here. I think they would immediately shoot, and it would be pretty aggressive. Daily tension traders have a very heavy footprint on the market. We could scroll back to find some. Sometimes they're not the easiest. Here's a couple right here. So 0 test, they have a heavy footprint. The daily trend traders do. 0 test at the open right there. You could see they defended it. Over time, conditions changed, but off the open, you can see what happened. There was a big defense that was a daily 0 test into the close, and it gapped up the next day. So it did work out. Here's a 0 test off the open right there. So they have a heavy footprint. 0 tests on the daily time frame are one of the most important things you can control. You need to control probabilities day to day. They reflect a lot of people. If you could, it's one thing to control some sort of trend movement on an intraday scale, but day to day, you move away from the possibility of dealing with margined day trading accounts, because a lot of them can't handle the overnight margin, or much less the overnight risk. So most people want to be flat into the close. So the only people willing to hold day to day are people looking at multi-day trends. They're trend traders. You have to be. So controlling the daily trend means controlling the trend. You can't separate those two, in my opinion. So that's the way I look at this. So losing this daily trend tomorrow morning would be devastating to this whole entire scenario. And that would mean that we're going to go back to the root position, which was here. This is where it all began, right through here. And then we had stop loss dips and stuff like that. And you could look at this one too. I think there was a test on that one as well. But it doesn't matter at all. I think it all began right about there on this day. This is where we started it all. So would be the objective. Those bears can take out that daily trend and the bulls don't do anything. That's where we're going first. That is the first place we're going to hit, because that's where it all began. So this is the amount of equity essentially in this trend. And if the bears win, they're going to extract that equity, which means head back to where it started. That's where we're headed. I think the bulls will defend. I think this was a difficult low. I think it was hard. I think there was a lot of blood, sweat, and tears put into it. And I think the bulls will pick it up. So that's what I think is going on. We're at a pivotal moment. We've got a good opportunity for bulls to come into the close. The bears have an idea of what they want to do, and they still have some big hurdles to deal with. I think if the bears really want to take this, what they need to do is they need to sell themselves. They need to say, hey, institutional traders, hey, people with real money, we can do this too. And if anything, tomorrow when this pops up, and I think it's going to, what the bears need to do is defend it and get it back down and say, look what we did, and sell that to the investors. Show the investors that you can control possibility space. Get daily tension down to zero. Show the bulls are failing. Get it under zero. Sell that. If you could do that, then the bears would have the chance of actually getting real institutional money behind their positions instead of these really quick reversing things that don't hold together for very long, and they don't build the right structure. Bears they're always laden with this, we don't have to sell to the investors idea. They think they can just come in and whip the market down and say, it's a bearish market. I'm like, I've never seen a bearish market, because bears are the worst. They don't sell themselves. They don't take time. They're in about the quick profits, just as quick as you can, try and push it down, get the fear, find the fear, and it stops and reverses. So that's what the bears are going to have to do. This is a big selling point, and this is one of those market philosophies that you don't hear a lot. If you have any other business, that's the way it works. You have to sort of sell yourself to the investors, and once you get investors behind you, you can do a lot more. You can expand. Your business can grow. And the bears have always been terrible at that. The bulls have always been great at it. The bulls come in and say, look what we did. Look, we defended daily. We defended it. It was great. And I mean, they did it here. Look at that. See that? Do you remember this? The bulls came in and said, look, we took out tension. And then they said, look, we have liquidity, and it worked, and we pumped the market up. Yeah, it moved down, but everything past there, you see that? This was essentially a daily zero test right here. And the investors said, okay, and they put money into it. This happened because the bulls convinced investors they could. It always happens like that. We see this all the time. That's why I prefer to be bullish, because bulls tend to be more structured, which means you can understand and trade with them and do things with them. Bears tend to have this like erratic craziness about them. It's just everywhere. Like it's like they don't do anything. They're either on or off. They don't like have this middle ground. They don't do that. I'm not a fan of the mentality of bears. I mean institutional bears. They're just, anyway. So I think this is a good buy. I think right now we have a buy. We're looking at a long. I think this decay retest, we're going to open up here. I think we'll open higher. And I think really the big fat question here is, can bears sell themselves to investors? Or are we going to see more of the same crap we always see out of bears, which is horrible terribleness, and they just do stupid things? And I wouldn't be surprised at all. If I wake up tomorrow and the bears just do terrible, stupid things again, I'm going to say that's what I always expect from bears. I always expect that bears dump a bunch of money into the market inappropriately just to drive things down and then get shot the next day because it didn't work. And if you think that that's crazy, you might say, well, they were able to make money. Sure. If they were just trading 1 or 2 contracts on the ES, sure. 10 contracts, sure. But if you're an institution, you don't have the luxury of tiny. You're scale. It's different to trade at scale. A little tiny move down of 10 points on the ES is not enough to support a multi-million-dollar, if not tens or hundreds of millions, across the whole market. It is not supporting that. 10 points that's not enough. Here's something. If you think about your account balance, if you have $1,000 in your account balance, and you take a trade and the margin on that trade is $300 and you make 500, you might say, hey, I made more than 100% on my position, but that's not true. What you did, you made 50% because your investors gave you 100 and they expect a return. It is not about your margin. It is about your full account. These investors think that way. So when you look at this 10 points down, you had a $1.2 billion trading account, pension fund manager of Texas or something, and you were able to make 10 points on the ES. Great. You made 0.01% profit this week. That's crap. They need more than a little move. They need more. They have to wipe out counter people. They have to control trends. Otherwise, they can't show a bottom line to investors, and that means money moves. So that's why I think that this little move down here looks stupid. It looks very stupid because they pushed it into a zero test. The bulls are getting a decay retest, which means they structurally have reason to buy into a zero test. And they still have to run into a daily test, which means there's still upside precedence. I'm sorry, this looks stupid. It looks like a dumb decision by the bears. And if you're sitting there thinking this was bearish, you're ignoring the structure of the market. You're also ignoring the reality of what it means to be an institutional trader. It's not like an institutional trader has their own money and they get to like just do whatever they want. They follow rules. They have to worry about profits compared to their account balance. They have to justify everything to investors. I mean, I don't have to justify crap to anyone. If I don't do well, you guys don't care and I don't have to tell you. If I do well, you guys don't care and I don't have to tell you. But if you fail as an institution, you got to face the music. And that means the risk is much higher. Social risk, I think, hurts just as bad as financial losses. Facing somebody who's like, so you lied to me, huh? You failed? Where's my money? You know, crap like that. So for me, I look at this and I think, okay, maybe their position, if they got into one this morning and if they held on to it, which as far as I could tell, they're still probably going to be there. Pumping that position just, that's risky. This looks like higher risk. And unless this person knows something, the rest of us don't, they need to dump. They need to get out of this trade because I think it's looking like it's going to pop up tomorrow morning and we're going to start running this bullish trend tomorrow. It looks like, I was hoping today we were going to get things going. I really was. I thought that's what I thought we were going to keep moving up. That's what that looked like to me. But it looks like the zero test got down. You see how the zero test, it accelerated after? Do you see that? Ask yourself, what would it take to accelerate the possibility of the space downward? Money. Usually you liquidate somebody, but we didn't liquidate a position here. This was not a full-size institutional position. That means somebody dumped a bunch of sell orders here. Somebody pushed down. Somebody. And it was dumb. That was a dumb move. Somebody is about to get screwed. So so I think this is going to move up. I anticipate an open higher tomorrow. It's not a guarantee. This is because of where tension is, we could open and the bears maybe have something in their mind. I can't know that. I can't know what insider information. So if this does move down overnight, that will tell me loud and clear, these guys cheated. In my opinion. Right now, I don't think they're cheating. I think they got into a position and it happens to be where it is right now. But if this does move forward, I'm going to say these guys, not for sure, this isn't as clear as some, but these guys knew something, especially at this point. So if something happens, if there's some breaking news overnight, just know that breaking news is a bunch of BS. I don't know what it is, but it's BS. It's generated specifically so that those bears right there, the ones from this morning, could take advantage of these bulls who are coming in right now, and these bears are probably sweating. If they know what's good for them, they should be sweating at the palms. So something happens overnight, know that it was fabricated, and it was fabricated after these bears realized. So there were probably phone calls getting made right here. If I just want to structure this through here, phone calls getting made saying, can we fabricate something? Can we salvage this position? Is it going to work? Is it not? Because that's what I would do. That's what I would do. If I was in control of those types of things, I'd be saying, hey, we got this pressure position. The bulls are coming in. Can we get something going on overnight so that we can shove this down? We just need a pop down, a real quick one. It doesn't need to sustain, but it'll damage the bulls in a way that's going to hurt really bad. It'll pop up tomorrow morning, I know, but it's going to really kick the bulls in the teeth, and it could lead to further setups that could degrade the bullish market. That's what I would do if I were a bear right now. That's what I'd be doing. So if it happens, no, it's not impossible to understand that's what's going on. If that doesn't happen, if we don't have those phone calls, if the bears can't muster something up, they're about to get crushed. Because I think this market structure suggests that this is moving up. We want to take out this position as our scope. We want to get this back over zero, keep daily up. That's what's happening. If we don't get some extracurricular activity, creates news, that's what's going to happen right here. Okay? So if you have tools that can take advantage of this type of thing, use those tools. This was a good trade, but this is the trade. So in terms of structure, in terms of everything lining up and getting to a point where you have a lot of good things going, this is the spot. The previous one was understandable. It was able to move profitably, but this is the trade. So hopefully you guys aren't getting, busted up and I didn't lead anybody to try and chase the market. I really hope nobody chased the market after that. If you didn't catch it this is my rule. If you didn't see it in the moment it happened, you don't get to profit. I don't chase things. If you didn't know something was coming, if you didn't see it happen in real time, do not try to make money off of it. Do not. Your risk curve, so if this is 0 and this is time going this way, this is risk. If you saw it in the moment, your risk is exponential. It is exponential. The longer you wait to get into something that you see happening in real time, your risk shoots up because trading from a position that's positive versus one that's negative is vastly different. So I like to take trades that I see coming. We saw this coming. We knew the zero test was coming. We just didn't quite know how it was going to line up, and it looked like we had some good structure. It didn't come the way that I wanted it to, but now we're getting that zero test, the one we were looking for, with some structure to it. So I like to see things coming before I execute on them. If they set up the way I want, that's executable. If they start playing out the way I want, that's holdable. Once they start not doing things that you want, you didn't expect that, it doesn't fit, stop holding on to it. The dang thing's not doing what you want it to do. Let it go. So this is the trade. This is the expectable, understandable, structural, institutional backed trade that I like to look for when it comes to trading. Do I think this is a trade that's going to go up and to the moon? Yeah. But I wouldn't hold for it. Take the meat and potatoes. You want to take advantage of the part where if an institution comes in with all that money, right? And let's say they buy into here just crazy. The initial pop, the impulse out of that structural cash injection, once that thing slows down, dump it. You took advantage of exactly what you want, money. The second leg after that, the further moves, you need structure, not money. You need structure. And that's harder. So unless that you have analysis that suggests things that are further, I think you should just look for the first impulse. And I know this is an opinion thing. If you want to do more than that, by all means, it's your trading account. Do whatever you want. I know you don't care what I think anyway. But for me, I don't need to catch the whole trend to predict and understand the trend. I need to catch the initial move because that's the easiest part of a trend, is the one where the cash comes in and it shoves so hard that it just really goes. And so you'll spend 2 days developing the market and 1 hour or less catching the impulse move. Sometimes I'll hold for different things and stuff, and I know everybody's seen me break every rule I've ever established, but I think impulse trading is the best trading because it's quick, your risk is low, you don't have to deal with a lot of cortisol in your blood, you're not constantly stressed, you're happier. The trades tend to have a binary, they're either they work or they don't. They're just easier to deal with. So in my opinion, that's the best type. It's to catch that impulse and just be happy. Let the trend traders deal with the stress of a trend. You focus on predicting the institutional behaviors, watching their initial cash injection, size up a little bit, and stop focusing on the little weaker trades. Stop trying to catch a couple here, a couple there. Forget that. Forget it. Catch the institute. That's institutional money. If these institutions are who I think they are, you'll easily be looking at accounts that are in the total size of $10 billion or more. All those accounts are going to be representing billions. So Jim's saying he knew I would like that long. I like it. I see what's going on here. So when they start buying in, you want to catch their billions. Quit chasing the stops. Quit chasing the little trades. Look for the real money. Get in with them. They know you're going to pick off a bunch, so they're going to be like, all right, we're going to lose $10 million in shadow traders, but we're going to make, I don't know, we'll just say $100 million profit, so that's going to be a $90 million profit. Okay, they just calculate that in and do that. Quit with all the little stuff, okay? And you cannot predict institutional trading unless you understand structure and the real competition of the market. So you got to stop focusing on statistics and stuff. You got to start focusing on the future. You have to consider possibility space and stuff. And I think it works with any tool system. This is just, I'm using momentum as my rudimentary starting point. I use momentum and I built everything out from there. And that's how all these tools function. So that's what I think's going on right now. That's who I think's coming in right now. I think there's this is a decent trade. Don't lose your head over it. If it's not working, don't suicide your account. I mean, this should work. If there's institutional money here, it's not going to sit around. Okay, so those are my thoughts on the market and where we are right now. Does anybody have questions? I didn't ask last time, and I want to make sure if anybody's watching and has questions, type them into the Discord or into the YouTube. I'm looking at the Discord and the YouTube. I have them liked. And I can answer those. So I'll give you a minute to type any questions in if you have one or something like that. Otherwise, yeah, I think you have my opinion about where the market's going. Nobody? No questions? All clear? Cool. 21. 21? Nice. What's 21? Okay. So that's where we're at. If there's problems, challenge me. If you don't believe something I say, challenge me, question me, ask me. Most of the time, not always, I say things for a reason. These tools are not just tools. I didn't find them in the free indicator list. I built them specifically. I designed them and developed them. It was a lot of work. So if you have questions, ask. Please. Don't run around and say, I don't get it. Or he's confusing. I know I'm confusing. Ask. Like I say the things that I say about these markets for a good reason. And if you're not understanding, you should ask. Or go into the Discord and ask. A lot of them have heard me vent. There's sense behind these things. So if something's not quite clear, make sure to ask or ask somebody on the Discord or stuff. Good. I hope I'm more than clear. Jim says I'm clear. So, okay. It's Phil asked real basic. What's the red line on the decay touched at the end of the day? Okay. No, this is a good question. And then there's another one I see Megastroke asked. So this red line, I'm guessing is the one that you're asking. This red line is the current value of decay. So it's the value of decay. So it's actually just that. Why is there a circle and why is it solid and sometimes it's dashed? Awesomeness. There's absolutely no reason for it. I just thought it looked cool. I wanted to draw a circle. Thinkorswim's sort of a notoriously difficult coding language for things like graphics and stuff like that. They did not design it for things that'll let you do imagery or shapes or things. It's just designed to draw a line off of a very basic function. And I wanted to draw a circle, so I forced Thinkorswim to let me draw a circle. As for the heavy red line, it's just so that you can see the current value of it and draw it backwards. It's heavy if it's under, it's dashed if it's above. Just because I could. There's it, yeah. And that's all. Megastroke, you asked, by momentum, you mean advanced decline line. And by momentum, I mean something very specific. Advanced decline is my starting point. So it's my data set. When I look at the data set of the advanced decline, that's sort of a starting point. I mean, that's in these indicators use a lot of data sets, but essentially the advanced decline. When I say momentum, I mean the analysis of digital signal processing. When you look at lines, one of the problems is that an analog line is not continuous, and continuous becomes a problem. Try not to get too much into this. Is a problem when you start using calculus, you know, dy dx. When you try to say things like what's the acceleration or the velocity, or what's the phase, you know, along like a sine wave, where at what point along that wave is it? It becomes a problem with discontinuous. So getting lines to become continuous is the process of DSP, digital signal processing. So what this whole McClellan thing is about, McClellan applied a really simple digital signal processing strategy. It was the difference between two EMAs. EMA 1, which is the fast, and the EMA slow. So the heart and soul of momentum is digital. It's the analysis of the digitization of the analog. That's momentum. And we're looking at calculus to figure things out. So when I talk about momentum, that's what I mean. I mean, we've digitalized something by using DSP, and then we're looking at what that means. And that's what momentum is to me. So you could do it with anything. If you have any time that you say to yourself, I'm going to use a 200 EMA and a 20 EMA, that's digital signal processing, because you're taking two smooth versions and you're comparing them to each other to create intelligent statements about the future. That's what it is. So that's what I mean by momentum. It's the digitization of analog. And then we're just looking at the digital version, and we're comparing that to the analog all the time, you know, and stuff. So that's what I mean. So advanced decline, yes. Momentum, yes. But momentum is that. So, I mean, you can go look at digital signal processing, take the time. It would benefit you greatly to understand it. I think for this context, I mean, there's a few momentum tools that you can look at that are free that easily you could, if you just look at the code, you can kind of understand how they work. They're pretty straightforward a lot of times. Megastroke, you asked, you said to catch the impulse move, but when is that on an intraday basis, assuming you're flat after market closes? Do you pay attention to overnight moves? Absolutely, overnight moves. Absolutely. I trade when they trade. I don't. It's just during market hours, the New York Stock Exchange publicizes the advanced decline. So one of the problems that you run into is a lot of things like this right here. Did you see this right here? Have you noticed this? XTO eligible. EXTO eligible means extended hours trading. You can trade this overnight now. You could always, but now you can. And now that, at least that's the selling point, right? So what ends up happening is a lot of stocks and things are EXTO eligible now. And that means that the advanced decline is not intraday, it's 24 hours. That means that they're getting data sets coming in all the time. And the thing with Thinkorswim is that we can't, whether it's coming in or not, they don't issue the data. So it doesn't really matter. So what I have done is extrapolated that data. So if you're going to say, well, what's going on overnight, you can go to, I mean, if you go to the Trade Trust Group website, it's not quite calculating yet because the market's still closed. But if you bring up this, and hopefully you guys, this is good. If you're listening, you can understand this. This number closes. A little white box will show up right here next to all of them, and they are the overnight, basically approximations of the advanced decline. So the ADI will give you, if you put it on a 24-hour chart like the ES, 24-hour advanced decline numbers. I have the stat ADI plotted, which is it is the 24-hour statistical approximation of where the advanced decline should be always, and that's why it's red. And so right now, statistically, I think the market should be at 243 on the advanced decline while it is negative 1,000. So that's what this is. When it's darker, that's the overnight session or Globex, and when it's lighter, that is the intraday session. And the same as if you plot the advanced decline, you'll see it. Anyway, if you go get on the Trade Trust Group website tonight, you'll see the little white boxes show up for the 24-hour numbers, and you can watch those overnight if you want to try and do that. So you're asking, do you trade overnight? All the time. In fact, there are months where all I do is trade overnight because that's all they're doing is waiting till the overnight session to get opportunity and then run it. I've done that. They happen when they happen, and you have to just understand the context and what they are. This one, if you're trying to go, if you closed into the close, if you made something good, be happy, and then just watch the market and see if it works. You need to find some inherent value in the fact that you understood what was going on. You need to. Making money is very important, but understanding is very undervalued. So that was a bit longer-winded answer, I think, than maybe you were looking for. But yeah, overnight all the time. You can see some of the 24-hour numbers on the live charts page. Miguel asks, what's the yellow line above velocity line? When do you use it? How does it help with the context? And okay, you're talking about this line here. This indicator is the portfolio orders indicator. Portfolio orders is an indicator that is plotted. So you see this over here? We have numbers on this side. This is indicators plotted over price. Or sorry, they're plotted onto price, but these have a left plot. I built them to kind of do this interesting thing. Anyway, what it is that this white line here is creating this over here. And if you take any indicator and you drag it up over price, so you'll get some, like if you put an RSI on here, click it and drag it over price, it will plot over it. They're not, one's just on top of the other. So this white one is plotted on top of price. The yellow one is plotted onto actual price, and it's physically plotted on there. So what that is tracking. I want to make this concise so that I don't. It's large market-wide volume, which responds to how the market is appearing to close. So if the market's right here and it looks like things are going to close lower, or it looks like they're going to close higher, as things look like they're going to close in different areas, I'm looking for large institutional volume that responds to this apparent direction the market's going. It's a little confusing, but the idea here is that we're looking for people or accounts or volume that is strictly trading based on the future. And the reason that's important to me is because I don't think institutions give a crap about where the price is right now. If they lost, they lost. Honestly, if the market's headed to a stop loss and it's going to get there, the institutions, the fact that it's headed there, this is now in the past to them. It's over. It's over. They're already looking what's coming up next. So I assume that institutions look at where things are going to close, and then they also look at where they're going to close by the end of the week or something, or the month. And so I thought, let's make an indicator that tracks volume that's strictly based on how the market's going to close. And then I plotted the intensity over price. So the further away from price it is, the more intense the volume is, or the higher the volume is. And the closer, so you can see, and I call this, it converges, so it's wider, and then it gets less and less and less and less and less until they stop. And then that turns into capital injection, oftentimes supports the market. And you can see right here that the amount of volume through this whole session was consistent. So consistent, there was just this like constant rate of volume the entire day. And so what I found is that this is useful because these institutions will buy all the way down, and then they will buy into dips all the way up. So you can see that they traded all the way down, and then they stopped, and then they bought the lows, and a little bit in the dip, and a little bit in the dip right there, and then they just hold. And the market starts to lean back, and they buy, and they'll buy all the way down. And it just gives us an idea of longer term, large volume traders. See, they're trading all the way down. They started early, all the way down, and they buy into those little dips, and then they just hold on the way up. Now, I don't treat this like a buy and sell signal. I treat this as sort of background noise to help me solidify the current events in the market. If the bulls are coming in here to buy today, we can see that there's people filling. They're filling. So is that useful? I think it's useful, but it's not something I tend to really strictly point out. It's a background thing that I look at as things are developing to say, oh, we have institutional people trading. And this really, what that tells me is that they're active. Do these events matter? I think so, yeah. People are trading them. When we saw this drop down and it was like a stop run and the bulls came in and it was like, well, does this matter? Well, yeah, as it started to move up, you see that essentially they just had a bunch of orders that got done filling right about here. And then they filled, but that was basically the end of it. And if you match that or you map it over to the context of what's going on, I think it's pretty useful. It's something I treat a little bit more background though. So I don't usually specifically point it out. I find that pointing things out tends to cause listeners to overvalue what I mean by it. So if I'm like, look, an institution picked up some orders into the low, a lot of people don't interpret that the way I meant it because you probably have other ideas about what that means. And so I'll treat it as background noise. I don't tend to focus on it too much because its value is more confirmation for me. So yeah. Alex asked, curious if you use it on a 5-minute. No. Okay, so the tension indicator I use it on a 5-minute chart. You need to understand something about this indicator. It is calculating 30-minute and daily. What this is doing is you are getting a 30-minute calculation on a 5-minute chart. A highly accurate one. And then the reason that it's smooth, because most indicators will do this type of thing. What the calculation does, which you can see better here, because this is actually doing a similar thing. This is a 30-minute calculation. So you can see the little pops here. That's because there's a 30-minute bar that closed. And what's happening is we're getting zero data destruction. So this is retaining the value of the 30-minute calculation on every single 1-minute bar. You can plot tension onto a 1-minute chart or 5-minute chart. Just make sure you have enough historical data on there to calculate it. So you'll need a couple of days. I honestly recommend as many days as you can get onto the chart for that. So I have this as a 30 days on a 1-minute chart to get the momentum calculated. On this, I have 180 days. I think it's the best way to do it. What's happening is this is doing what I call phasing, and it's smoothing it out in a way that reduces, which the idea is I didn't want a moving average. Removing averages destroy data sets. So to get things clearer, you have to destroy accuracy. There's no way around that. So I thought, can we optimize in the middle? Can we destroy, is there a way to say destroy as little as possible to get as much clarity as possible? And that's what this phasing is, or you could call it extrapolation is, or well, it's interpolation is what it is. You could call it interpolation, but it's essentially trying to retain every little pop and click and move and up and down in the analysis and also smooth it. So you'll see every little movement on tension represented in the smoothed version. The reason for that is because it's kind of ugly to see a data set that does, and you're like, well, can't you just kind of smooth that? It's like, well, yeah. So that's why this is smooth. This is not a 5-minute calculation. This is a 30-minute calculation, and it is highly accurate. It retains all those data points. That's a big deal because a little tiny move up will change it. You'll also notice on the velocity, just maybe this is a side note, if you zoom in, well, you can't really see it here, but as it gets closer to 0, if you have the markers on, this will actually retain the high and low of the bar as well. So the velocity number is better for that. It retains all the data points, the high and the low of the velocity number as well as the value. That way, if it does cross over 0 at any time during a bar, it will not lose that data point. It will stay. So that's, for me, that was just a really important thing. The velocity, the tension number doesn't retain the high and the low because it's not important. Tension's a little broader. So I put it on a 30-minute chart because I think it's clearer. You can do a 1-minute chart if you want. I don't recommend it. It wasn't built for a 1-minute chart. It's built specifically for a 5-minute, 180-day chart. It is a 30-minute calculation and the daily calculation. And people ask, how is the daily calculation moving? It's because I'm retaining all the data points through the day. I didn't want to lose any of those. So a normal indicator would have just grabbed the last value that it had and plotted a flat line for you, which I thought was just horrific. So yeah, I mean, tinker with it. I mean, mess with it. I tried to build these indicators to be resilient and to have enough redundancies and things to protect them against things like blowing up on a chart or breaking. One thing I can't fix is you don't have enough data. So make sure you have as much data as possible. Yeah. Megastroke. Right. Megastroke, you're good. No, you're right. You're calling me out on my BS. You're saying, but overnight you don't get advanced decline data. You are correct. So we have to infer what that is. So during the 24-hour session, we do get a lot of data. We do. And so what happens is I build this like mesh, and this mesh represents the topological relationship between the advanced decline numbers, all of them, there's 16, compared to their respective indexes. There are many, and those boil down to their main indexes and their main index futures. And then I have it set up so that every data point that they will possibly let me have, which is primarily just futures, but if they pump them in, it'll accept them. And I reverse engineer what the value should be based on this complicated 3-dimensional mesh correlation network. And then during the overnight session, we use all the futures markets that we can put in that have a good causal relationship to the advanced decline. And then we reverse engineer what it likely should be. It's not perfect, but if you're looking to see what the advanced decline is likely going to open as, you can now look, and it does a pretty good job. As long as there's nothing really aggressive overnight, maybe some insane thing that could throw statistics off. Typically things are pretty close, but even if they are, it still gives you a good idea of what the market's going to look like at the open. So you're right, I cannot get advanced decline data overnight. So that's why I put in so much stupidly put in so much effort to calculate the advanced decline during the overnight market. And that's how I'm doing it. So it is what it is. You can check those numbers overnight, or if you have the indicator, you can just put it on a 24-hour chart, and during the overnight session, the little white boxes will appear. And the reason that I did that instead of just having it continuous is because it closed at negative 46, right? And if the 24-hour numbers say positive 30, you'll find yourself going, wait, positive 30, what was it at the close? And that drove me nuts. So I separate them so you can say, oh my gosh, it's moved up a ton or down a ton. Or if it says negative 46 and you're like, it didn't go anywhere. That's useful to know, to compare. So watch it. I mean, watch it, test it, try it, drill it, challenge it. I didn't build these tools just making them and running. This is years and years and years of doing my best to challenge and question everything and really push and develop the tools to be sensible, reasonable models of reality. and we're trying to derive that understanding from it. So if you find a really big problem, it just doesn't work, or you have an improvement, I'm open to it. I mean, I'm a little slow, as everyone will tell you, when it comes to development, but I never stop. So it might take time, but make your suggestions. If they're good suggestions, we can talk about it. I'm all for it. Nate, pit tag the overnight low. The color of the McClellan tension line be used as signals, or does it need to confirm the other tools? Okay, so the tension indicator, the objective in the color was the same as they're based on moving averages. My goal is to make it somewhat resilient to false color changes, because if you just did up and down, you'd get it would look like a mixture between red and green instead of red and green, because it happened a lot. So I want to make it resilient, but not too resilient. And so this is taking a moving average of a couple of different features and analysis parts. It's like if you have your data set and a couple of steps along the way, and I thought, well, how about we just measure the along the way steps, pull those out, and then use those to try and as effectively determine which way things are going to go. And basically what it means is that things are moving up pretty strongly when it's dark, things are slowing down or slow, not slowing down, they're slower when it's light green, moving down aggressively, slow when they're lighter. So there's 4 colors there. I think signals are the bane of traders. I think they are the destruction of most accounts. I think having things that generate signals ruin more capital than anything on this planet. I think markets destroy capital by making you feel like you have a signal that's safe and which emotionally allows you to lose money. I don't like signals. So this is not designed to signal. It's designed to model. They're different. All I care about is structure. Who, what, when, where, why, what are they looking for? Let's look at the future. So when this is red, I look at it as moving down, but that means nothing to me, because why is it moving down? When it comes to the daily, it's just under is red, over is green, and that's it. But the colors are just to kind of let you know that things are slower, faster, maybe more aggressive, possibly stronger. I don't use them at all. I almost never pay attention to the color of tension. But it is an effective, the best model that I could come up with to determine if things were moving more aggressively or more slowly with respect to the direction that it's going. So this is rising and it's light. It means that things on the inside, the calculations are slower. They're not as aggressive. They're not as strong, those types of things. So that's what that is. I don't like signals though. I like signals that I expected, meaning I wanted it to, I'm like, I need a signal. Where's my signal? I expected it. It fits into the structure. I know who I'm up against. I know who's paying me. I understand all the things around it. Then a signal is the last piece to the puzzle. Signals are the tail end final thing that you consider after a lot of analysis. So if there is a signal there and it is something that you want to try and use, it should be the last thing. The problem is that every time I make an indicator with a stinking signal in it, you traders just look at the signal. Drives me nuts. It's like, oh, there's a buy signal, so up. And I'm like, you have shut off your brain and ignored everything that's going on because a little green triangle. So I actively do everything I can to ignore signal generators. I did cave and add signals to the velocity because they're so common and it's useful. I already know that a lot of traders will shut off their brains when they say a green or a red dot, and they will say, it's down because it's red. And I'll do this. That's not what it was for. It was to make detecting crossovers easier, and that's it. So you didn't have to zoom in and look or something. Every time I do it, traders think that the signal overpowers the context, and it makes me mad because it's like you're sitting in a room having a wonderful conversation, and somebody performs some action, and it's like somebody across the table says, "Oh my goodness, I can't believe you're asking me for money," or something like that. It's like, I didn't say that. They're like, "But you leaned over in a way that generated a signal, and so I know you're doing this thing," and it's all awkward now. It's like, oh my gosh, were you even listening to the conversation? So I don't like signals. I don't think that you shouldn't use them. I hate them. They drive me up the wall, especially as somebody trying to convey information. They just blind people. It's like I hit you in the face with a bat. So if you have something with signals, fine, use it. That's okay. But in terms of these tools, putting things in that generate signals has actively been a sabotage on traders. They cannot turn their brains on when they believe there is somebody going to feed them for free. If you think there's a signal, you won't put in the effort that it takes to make money. You'll put in the effort it takes to lose money because you're addicted to gambling and you like losing money. You want to say, I want to do nothing and make money. And that's how the world works. And that's why you're going to lose money, and knock it off and just don't even ask. You just frustrate the crap. You're right. It is. It's capital weighted, and it's capital weighted in such a way. So Megastroke said, but the S&P 500 is capital weighted, and you're right. And I have considered that. The S&P 500 is capital weighted in such a way that the size of the size of the position that is not saturated with margin is more important to price direction than anything else. If you can execute a position on the S&P 500, which is a decent percentage of the market capital and is not saturated by margin from your stupid broker who will tell you to your face that they're not adding it, and then they do it anyway, because that's their true power. The true power of markets is margin. If I add margin to your position, you have no power to move price. The S&P 500 is specifically designed to make it so that the size of money is more important than anything on the planet. They can quickly just start saturating one side of the market with margin, and that side has no power to move. It doesn't mean they're going to lose, but it does mean that they have zero power to fight. There's no money there. It's not real. So I have considered this, and this is a big important feature of markets. It's that things are capital weighted, which means their money makes money, not being right. Truth doesn't matter. They're not truth weighted. It's money. So we track money. And so I've considered that, and it considers more than the S&P 500. It considers all of the indexes and the index futures and the volatility indexes and everything I could find available to do that calculation. It's as best as I could come up with. And you're going to have to trust that I've done my work. And if you don't, okay, I will need to continue to do my best. And hopefully over time, you'll believe in my credibility. But I did the best I could with everything Thinkorswim would offer me to put that together. So you're right. It is capital weighted. It is. And it is entirely unfair. It is. There is actually an equal weighted. Do you know that there's I think it's the SPEW, the S&P 500 equal weighted. Check it out. It's equal weighted. So you could see what the index would be if it wasn't capital weighted. It's interesting to watch. It's useful if you were to compare those two. You can derive some sense of what the heavier versus the lighter ones are doing. There's also a new chart they just put out. Maybe you guys don't know about this, but I actually think it's pretty neat. I'll show you really quickly, and then I'll be done. If you come into your, not that one, tools, charts. Which one was it? Now I forget. I'll find it. I was just looking at it the other day. I thought it was pretty neat. Analyze, that's an analyze fundamental. Type in SPY, and you can get a pie chart. Look at that. So that's the holdings. We can switch it to let's see this one. There's a holding versus sector. So this is the holdings in there, and the holdings is roughly the same as the capital weighting because of the holding. So you can see, and then you can look right there. Microsoft and Apple are the big heavyweights, and you can see how they are. So this is, I think, interesting. You can see that's how it's weighted. And that's useful because it's sort of irritating to find the capital weighting of particular stocks. If you want to do those calculations, you have to like get online and sit and look. So this is kind of a nice way that you can look up those weights in the market. So ETF is RSP. What do you mean? I'm not sure what you mean. Okay, so we answered a couple questions. This went a little longer than I was hoping, but I hope a couple people got answers. I'll stream again tomorrow. If you have questions, then you can ask me then again. Good luck trading, guys. See you tomorrow.